Here's the secret behind the most profitable marketing agencies out there, and it doesn't come down to getting new clients or delivering an amazing campaign. It's about tracking the right KPIs, the numbers that tell you how your business is actually doing. My name is Rehan. I'm a chartered accountant and agency CFO. I've helped hundreds of agencies make more money and pay less tax. In this video, I'm going to break down the 5 KPIs every agency needs to track to drive profitability. By the end of it, you'll know exactly how to calculate these KPIs, what they tell you about your business, and what numbers you should be aiming for. But first, let's start with the basics. What is a KPI? KPI stands for Key Performance Indicator. They are specific and measurable numbers that tell you how well your business is working towards achieving its key objectives. In simpler terms, they're the numbers you should be keeping an eye on to make sure your business is on track. The right KPIs will help you spot problems before they become problems. They'll help you drive profitability, and they'll help you make better decisions. Now let's get into the 5 KPIs that are crucial for every marketing agency looking to maximize their profit. The first KPI we're going to look at is gross profit margin. Gross profit margin tells you how much money is left over after you paid direct costs to deliver a piece of work. To calculate it, you take the difference between your revenue and your cost of goods sold, and you divide it by your revenue. Let's say your agency made £100,000 and it cost you £40,000 to deliver that £100,000 worth of service. To calculate your gross profit margin, you'll take 100,000 less 40,000, which gives you 60,000, and divide that by the £100,000 of revenue. That means your gross profit margin is 60%. But the next question is 60% good? If your gross profit margins are too low, you're eating up too much of your revenue in delivering your service, which means you've either got a pricing issue or a resourcing issue. For a marketing agency, we want to aim for a gross profit of between 70 and 80%. This indicates your agency is managing its direct costs well and is turning a healthy profit. Or another way to look at it is it's a good indicator that your pricing and your delivery method are optimized. After gross profit margin, the second KPI you want to look at is net profit margin. Net profit margin tells you what's left after all your other costs. To calculate it, you take your net income, which is essentially your revenue less every single cost that you have incurred, and divide that by revenue. So in the previous example, if you made £100,000 of revenue and incurred £40,000 of cost to deliver it, your gross profit is £60,000. You've then incurred overheads like rent and insurance and other costs to keep the business running. Maybe they total £20,000, which you would take off your 60, leaving you with 40. So you have £40,000 of net income. If you then divide that by your revenue of 100,000, you'll get your net profit margin at 40%. That means for every pound of revenue the agency earns, you generate 40 pence of profit. Net profit margin is a critical KPI because it indicates the overall health of the business. For a marketing agency, a healthy net profit margin ranges from 20% to 50% and is heavily impacted by 2 things. Firstly, how you resource, so freelancers versus permanent payroll staff. And secondly, whether you're remote or office-based. If you're office-based, you can expect your rent to form a large part of that overhead, which means that you'll be on the lower end of that net profit margin benchmark. If you're a remote team without a prime office space, then you can expect your margins to be towards the higher end of that range. Higher margin means your agency is profitable and handling expenses well. Now, once we understand profitability at a gross profit and net profit level, we want to dig a bit deeper into how your team is delivering that work. The next KPI is revenue per head, which kind of does what it says on the tin. It tells you how much revenue is being generated per team member. It's calculated by dividing your total revenue by your total number of employees. For example, if your agency made £1 million and you had 10 team members, you would take $1 million divided by 10 and you'd have £100,000 revenue per head. It helps you understand if you're getting a good return on the investment you're making in your team. A good benchmark for revenue per head is anywhere from £150,000 to £250,000. Higher numbers indicate your team are productive and the agency is using its resources in an effective way. The fourth KPI looks at your team in relation to revenue from a slightly different angle. It's team costs versus revenue. This compares the total cost of your team, including salaries and benefits, against the amount of revenue they generate. So where revenue per head is looking at the number of employees, we're now looking at the cost of that team. Calculate it is really simple. You take your total team cost divided by total revenue. So if your team of 10 was costing you £600,000 and they generated £1 million of revenue, your ratio is 60%. This means that 60% of your revenue is going towards paying your team. This KPI is critical to ensure that your payroll costs align with the amount of revenue your business is generating. A good target here is to keep team costs at around 40% of revenue. And the final KPI related to cash flow that's super important for an agency is receivable days. This will measure how many days on average it takes for you to get cash in your bank after you invoice a client. So many marketing agencies struggle with cash flow, and the main reason is because they're not converting invoices to cash quick enough to cover their costs. Calculate it and you divide your accounts receivable, so how much money is owed to you, by the total number of credit sales you made in that period, and you then multiply it by the number of days. For example, if you're owed £50,000 and you made £200,000 worth of sales in a 30-day period, you would take 50,000 divided by 200,000 and times it by 30. That gives you 7.5 days. This KPI is telling you that on average, you're converting invoices into cash within 7.5 days. If your receivable days are too high, it means that your clients are taking too long to pay you, and you could fall into the common cash flow issues that marketing agencies suffer from. Now, as a benchmark, your receivable days want to be as low as possible. It really comes down to what terms you have with your client. But if your terms are 30 days, for example, the starting point would be to make sure your receivable days are definitely not higher than 30. The lower the number, the faster your clients are paying, the healthier your cash flow. So now that you know the 5 KPIs that drive profitability in an agency, how do you actually use them for yourself? First, it's important to regularly track and analyze these KPIs. Set up a system to monitor these numbers at least monthly. This will help you spot trends and make micro adjustments that you can then measure the impact of and constantly improve. And then use these KPIs to inform your strategy. For example, if you're seeing your gross profit margin slip, you need to look at how you're resourcing or how you're pricing. If your receivable days are creeping up, then tighten your payment terms and make sure you have an effective credit control process in place. By taking action, measuring the impact of your KPIs, and making adjustments to your strategy, you will drive profitability within your agency. If you found this video useful, give it a thumbs up below and subscribe to my channel for more agency finance content.